Hello everyone, a very good evening, and welcome back to another wonderful episode that we have lined up for all of you under the AIKI series, which is of India Karega Invest. So I see a lot of people on the call already. Hi Nirmala, Panku, Biswajit, Jatinder, Sneha. Many of you on the call, thank you so much for joining us. We also have a very interesting speaker with us today, and we're going to talk about a very interesting topic. So, today's topic is how to plan your investments in 2022. And I'm sure a lot of you would have this question because the equity markets are so volatile, and we always left wondering what should we do in 2022. We've done so many episodes, so many videos, so much content for all of you on different aspects about investing. But then this question will always remain that in this particular year, if I have to plan my investments, and what is it that I should be looking at? So today with us, we also have Mr. Arvind Chari, who's the CIO of Quantum Advisors, and he's going to be our guest speaker. And he's going to give us some wonderful insights on how to plan our investments this year. But before that, I'll just start off with giving my two bit on this. So the structure of the session is that I will start with a little bit of my views on this, and then we'll have Mr. Arvind who will give his presentation for the next 20-25 minutes, followed by Q&A. And I'm hoping that we're going to have a lot of questions from all of you. So keep posting your questions, and Mr. Arvind will make sure that he's busy for the next 1 hour answering all the questions for us. Okay. So I want a lot of questions from all the viewers, and let's get started. So I don't have any presentation, and I'm just going to quickly talk about, what I think, or what is it that 2022 looks like. So in equity markets and 22 are really like at crossroads at this point. I mean, we had a great 2020, we had a great 2021. I mean, there was performance across sectors and lots of new investors that entered the markets, and everything is going great. But then 2022 looks interesting and equally stressful at this point in time. I mean, we're just at the beginning, but at this point, it does seem a little stressful. So let's see what's really working for us, right? I mean, of course, a strong economic recovery. We are supposed to be the fastest growing economy in the world. Moderate inflation forecast by RBI, which is good for the upcoming quarters, which obviously is it works well. Good forex reserve compared to where we were in 2013. But then what's going against us, and what is it that we should be a little worried about, right? So US inflation at this point is at 7.5%, which is highest in decades and the fastest increase in inflation in the recent past. Expected increase in interest rates by Fed, which is something to worry about. Expected reduction of quantitative easing, what we call as tapering. And then, of course, like the geopolitical factors, there's a near war situation between Russia and US over Ukraine. So, when we look at all these factors, we obviously get stressed out and we get worried. And then we really want to understand then what's in store for us in 2022. I mean, how much this tapering is going to affect the Indian equity markets, and are we going to face, another tapering tantrum, as we call it, like we faced in 2013, which was near catastrophic for the Indian economy. So to know more, I would like to call on our guest speaker, Mr. Arvind, to give his views on this, and then we'll take all the questions from all of you. So over to you, Arvind.
Namrata, thank you so much, and great to be back to speaking at a Groww webinar and speaking to all the investors. As Namrata said, I would like this to be interactive. So I will do 20-25 minutes of my presentation, and then we will go to a Q&A. And please, you can post your questions, keep your questions ready. I'm happy to extend the session to be able to answer whatever I can. I will not answer stock specific. I will not answer mutual fund specific, like scheme specific, but I will try and answer everything that I can answer. I think I have an answers for. I normally say this at the end, but because Namrata gave the introduction, and I'm going to tell you right up front that at the end of it, you have to try and keep your investments simple. That's the one. If you want to take one message, that's the message that you take. That keep your life and investment simple. It's good to know about all these things. It's good to know about the markets. It's good to know about the economy, about taper tantrum, about Fed, about inflation. But at the end of it, if you're not a full-time market investor like me, or a trader, or somebody who's focusing on financial investment, or a financial planner, but you have some other job, and investment is only your vehicle for wealth creation and safety and liquidity, then you just need to focus on that, and attend these sessions, read about it, get to know, but ensure that your investment philosophy and the way you plan investments is simple, right? And I'll show you how you can make it simple in the way we think about it at Quantum for many years, and I'll discuss that, and I'll take questions on that. But that's my main message. Try and keep your investment as simple as you can. So I'll share my screen. I'll put my presentation. Namrata, can you see this?
Yes, it's visible.
Can anyone confirm whether they can see this?
Yes, Arvind, it's visible.
Okay, yeah, great. So yeah, this is the complication, right? This is global asset allocation, different asset classes, broken by returns, broken by years, 2012 to 2021. This is not my chart. This is made by Jeffries, the research, and it's all. Think about global asset classes, equities, S&P 500 in that, global equities, growth, value, credit, even crypto, and global REIT. So, and as you can see, returns in any particular calendar year are all over the place. And most often you will find that a asset class which did very well in 1 year typically does not do very well. Of course, there are differences. There's always, you always see a growth in a growth cycle, say equity is doing well over 2-3 years. That also happens, but mostly, especially in fixed income, if you have a great year in fixed income returns, and like if you get, especially in India, if you get double-digit returns in fixed income in one calendar year, you should more or less assume for the fact that the next year returns will not be that much, right? And that's how it moves. So, which is why people say asset allocation matters, because you even somebody who's full-time in the market cannot time this, cannot make money consistently, cannot switch between asset classes and allocations over a period of time. So that's the essence why people say you have to asset allocate, and you have to have allocation across asset classes which meet your goals and requirement. Nobody needs to be in all asset classes, but nobody can be only in one asset class. There has to be some diversification, and everybody needs that diversification. It'll be hard pressed to find someone who just who has only one goal or only one requirement. There'll be at least a requirement of some emergency corpus and wealth creation, or emergency corpus and wanting to have very liquid, safe money. So that's the main. And so you remain allocated to different asset classes. The percentages can change if you can't do it on your own. That's why entities like mutual funds exist. That mutual funds allow you to take that asset class or international, domestic, equity, debt, gold, crypto. You can make all those allocations by remaining investing in mutual fund, and either trust your allocation and so that allocation makes sense. And entities like Groww will help you, tell you what your allocation should be, how much should be in equities, how much should be in debt. Or you invest in a broad multi-asset kind of product and allow the fund manager to make that allocation. Because this is not easy. This will complicate your life. Good to know, great to understand, not so easy to follow. You can make your investment simple, as I said, but you can use variety of instruments to do it. But this is how, when I see as an allocator, as an asset allocator that I am, when I see these kind of opportunities or these kind of risks that emerge, and we look at all these things to figure out what should be our message be to investors and what should we do on a portfolio, right? And this is not only global, it what matters in India. This is the asset allocation quilt that Mint comes out with every year. This is, and again, calendar year. And this is Indian asset class. So you have GSEC, which is government securities. You have small cap, you have gold, you have mid cap, corporate bond, real estate, large cap, credit risk funds, everything put together. And here also you will see the same trend. It's not consistent. The leaders of 1 year may not be the leaders in the next year. The leaders in 1 year typically become the laggard in the next year. And returns are all over the place. Like it's like 2021, which is what we are discussing, and then 2022 as an outlook. 58% in small cap as the highest return, and gold was -1%. Right? So returns also tend to be, there's a wide range between the top performing asset class or asset category and the bottom performing. And again, same message, right? Asset allocation matter. You need to be allocated. You can change your weights on equity and liquid depending on how you sense or what's your goal. But more or less, you need to be asset allocated. This is the if I look at just the three main asset classes that people look at, like bonds, Sensex, and gold. This is again India. This is again in Sensex and gold, as gold prices and bonds is the CRISIL Composite Bond Fund Index. And most asset allocation that we do you will have to keep these three main asset classes into mind. And I'll talk about why and how you can allocate without more complicating it. You can have a simple allocation in these three asset classes. uh, if I look at from a 2020 and 2021, so 2 calendar years, and then I put a 2-year CAGR returns, right? And I've given you different. So there is the World Equity Index, the EM Equity Index, and that's all relative for India, right? India is you might think India is Atmanirbhar and India is in a microcosm of its own, but it's not, right? India is also dependent on what happens globally in terms of flows, in terms of interest rates, in terms of global growth, global activity. And as we saw with the pandemic, everybody got impacted, right? So there is we might still have certain basic macro parameters which make us separate, but we are still fairly linked to the global activity. And then I've put commodity index because that's the main thing, right? Inflation people are talking about and the increase in prices. Bitcoin, of course, and I'll talk about crypto. I'm pretty sure I'm going to get questions on crypto. And then I put the index in INR terms. So the first two parts are in dollar terms, and the last part is INR. And you can look at India has done phenomenally well. Look at the 2-year CAGR in rupee terms. Dollar also won't be very different. The rupee hasn't depreciated as much. Fairly significant, strong returns, as Namrata also mentioned. Although all that uncertainty about COVID, everything that came out, but equity markets have been very, very strong. Corporate earnings have been surprising on the upside, and I'll talk about that. If you look at the red circles that I've made, look at EM bond, right? Indian bond also didn't do as much as a CRISIL Composite Bond Fund, so 7%, which is good from a 2-year CAGR. But the EM bond ETF is minus 5.5, minus 13 for 2020. So that tells you that some emerging markets are already facing inflation pressures, they're hiking rates, and then hence bond returns are lower. EM equities also. If you compare MSCI India equity and the MSCI EM equity, India has outperformed the emerging markets. So there's something happening for India as compared to, say, a China or a Brazil or a Russia, where India is able to outperform in a significant manner. And we'll have to wait and see whether the outperformance continues, and I'll talk about that also. So this is my summary of the evolution of the outlook. Is this will be a year of divergence, and when I say divergence, I mean it in three parts. One is when there was a crisis in 2020, the pandemic, all central bankers globally did the same thing, right? They cut interest rates, they added liquidity, and they supported the financial markets. Everybody did that at the same time, almost at the same time, right? But the exits, which means some emerging market central banks have already reduced liquidity, they've already tightened interest rates. The interest rates are now much higher than what it was pre-pandemic. The developed world central bankers, which is the US and the UK and Europe, some have already done it, or some are now talking about, okay, growth is back. I don't need liquidity to be as much. Inflation is a big problem. I'm going to hike. So they are exiting in a different time frame and in different pace. India yesterday, what I thought RBI was needlessly dovish, right? Not even talking about normalization, which is reducing liquidity and increasing interest rates. And I can answer questions on that, why I thought they were needlessly dovish. But we are trying to find a very different path. And in the global backdrop, it's very different, right? Today, commodity prices are significant, especially for a country like India, which imports oil. Oil, when at about $80-90, it becomes tough for India. Right? That's not a good short-term macro scenario for India. In that period, we are not even talking about hiking rates. In a period where the Fed is very hawkish, and globally rates are going to be increased, monetary conditions will get tightened. So that aspect of entry was synchronous, but the exit is going to be very desynchronous. It's already happening. That will create divergence. There'll be divergence will be also from the point of view that what I expect from the central bank and what the central bank delivers. In some cases, it will be hawkish. So I expect the central bank to not hike, but the central bankers are actually hiking more, which is what is happening in the US. Nobody talked about rate hikes in 2022 about a year back, right? And now people are expecting 7 rate hikes in the US in 2022, like a sea change, right? And now we have to see whether the Fed actually hikes as much, or they actually control and manage the increase. So that will have divergence. The other divergence will be on returns, right? Like in fixed income, for example, like you've seen savings account and liquid funds and money market funds having very low returns, right? Because the repo rate is at 4%, the reverse repo rate is at 3.35. As those returns go up, some amount of fixed income funds will actually do well, right? The money market fund. But some amount of some other fixed income fund, like the short-term funds, which already had a reasonably poor year in 2021, might have a poor year in 2022 also. As oil prices go up, as interest rates increase, you might see a increase in bond yields, and hence a lower performance from that segment. So this will be a year of divergence in terms of returns and expectation. And my general advice is that try lower your expectations from expect from returns from equities, some amount of fixed income, and also from commodities. This I don't, given the backdrop that we are in right now, entering into the first half of the year, doesn't look to be a very high growth, high return year. And as I said, because of the divergence, you'll have two-sided volatility. So you'll see some great periods in between, and then you'll see some very sharp sell-offs, and that can happen. uh, Crypto, as some of you would have heard Governor Das saying that crypto does not even have a backing of a tulip, referring to the tulip mania. So I think very strong comments from the RBI on how they see crypto, and I'll take questions on that. So how do we see Indian equities? We actually believe that India, from a macro growth perspective, is on a cusp of a upcycle. And if certain things go well, if the government actually spends in an efficient manner whatever they're spending, whatever they announced in the budget last year and this year, in the years forward, this will continue to the growth momentum. And last time we saw that was in the 2003-2007 period, and we are having very similar tailwinds. If you look at the corporate Indian balance sheets, debt levels have gone down. Tax cut has helped, so the companies have repaid their debt. The large companies' balance sheets are much stronger. They have cash on the balance sheet, or profitability is increased. At the other end of it, if you look at the banking sector, which faced the brunt of that earlier capex cycle and corporate India having high debts, they also are in a better situation. Capital adequacy has never been this high. Almost all banks have raised capital. NPA levels are higher, but it's going down. Provisions are enough. Banks can also take risk. I mean, they have the balance sheet to lend. So if there is an increase in capex, which can also happen from exports, because after the pandemic, all central banks and all governments expanded their balance sheets, right? And that has helped global growth come back. And you're seeing that impact in global exports, in India's exports, both in goods as well as in services. So, and that is typically a good start for a capex upcycle. So when companies see more export demand and they meet that export, they will also invest and create that demand. And that export earnings is actually a demand generator. We are seeing one of the biggest multipliers that India has is real estate. When people build and buy houses, it has a multiplier impact, right from buying of the land to constructing, to taking the loan, to refurbishing it with consumer durables. So it has a significant multiplier. And we are seeing the first signs of a residential real estate turnaround, which has been stagnant or falling since about last 6-7 years. That's again a very good sign. And in that period, in these kind of tailwind periods, of course, we have headwinds also, which is oil prices short term, and second is our disappointment with the government that they I think India still needed to have some support of income, or reduction in taxes, or some support for MSMEs more than the credit guarantee. So that has kept demand and sentiment a bit low. But otherwise, we are entering into a growth period. I think growth can sustain going forward. And when we see that, we see a strong earnings cycle. Corporate India tends to do very well, and we saw that as the right chart shows. If you look at the blue line in the period 2002 to 2007, you're seeing a significant 20-30% compounded increase every year, right? It's not only 1 year, 2-3 years they've been doing it. And the left chart shows why for the first time in about 6 years, we're actually seeing consensus, which is sell side brokers upgrading their estimates of earnings. Typically, what used to happen between 15 and 19 was they will start with a high expectation, and then as the year passed by, as growth didn't come about, GDP slowdown, they will cut the earnings estimates or EPS estimates for the Sensex companies. FY21, 22, 23, they're seeing the first time that they're upgrading their estimates, which is a good sign. And this tends to be a good period for in the medium term for equities. So I talked about the tailwinds and also spoke about the risks. So of course, COVID, uh, our sense is that we have learned to live with COVID now. Both the government, industry, and even individuals. We now know, or we are able to manage with COVID. Unless there's a very bad Delta kind of variant that comes back, I think we should be okay in managing COVID. Inflation is something which need not be a short term, but it can actually remain for a long time. And I think the government has to take, not only in food, but if you look at the amount of import duties that the government has increased to, to give support to Make in India and Atmanirbhar Bharat, can also have an impact in the short term where domestic prices go up, and they should be able to figure out a way to control that, either by reducing taxes or by reducing import duties in a big manner. Uh, Inflation is a worry, and I think India should be very careful in how they do it. And the third, as I said, I think we still need some income boost, some income support, some sentiment booster, which will there's a capex cycle that is going, aided by the government, and then eventually, hopefully, followed by the file for corporate India. And there's a demand side boost also that comes about. That is missing as of now, which will have some impact on how we see equities. From a valuation perspective, of course, Indian equities look expensive, but as the previous chart showed, if the earnings does come through, so then this P is not reflective of the actual earnings that can come about in the future. And equities are typically future pricing, at least 1 to 2 years ahead. So valuations look at expensive right now. Also, relatively, India is expensive than say a China or a Indonesia or Brazil. So you might see foreigners selling, which is what is happening in the short term. But over the medium term, we believe these are very, very positive trends that we are seeing for Indian economy. In fixed income, uh, we are in a, I use the word perfect storm, where because the US Fed will hike interest rates and tighten liquidity, and there is Indian government also themselves having a very high fiscal deficit is the difference between what government revenue and the government expenditure. So the wider it is, that means they're spending more than what they earn, and then they're borrowing that. That borrowing typically happens by issue of government securities, and that's what is called the government bond. And the right chart shows you the sovereign bond yield curve. So from 3 months to 24 years, what are the yields available on the government bonds? If you look at the blue line, which is after budget, just after budget, you see a increase over Feb 2020, which is just before pre-COVID. So the curve was like this, as you call flat, and the curve became steeper because the RBI reduced short-term interest rates. The RBI put in a lot of liquidity, so short-term rates like 3 month and 1 year rates are like below 4%. But the longer-term rates, as inflation increases, as the government borrows more, as they have more fiscal deficit, the long-term rates have become higher. So this is how the current situation is. Even in the global sense, if you look at the left chart, since 15 December, and I use that day because that was the day when the Fed kind of pivoted. They were saying that inflation is transitory, and the Powell of Jerome Powell in his testimony said that inflation is no longer transitory, which would mean that the Fed is now worried about inflation and they will act on. And you've seen bond yields since then, and India has also kind of mirrored global bond yield increase, right, in most respects. And so this is why fixed income returns, this will be a tough year for short term, as that blue line at the shorter end, as that goes up, as I said, returns will get better. But on the longer end, if oil goes above $100, if the Fed hikes more than what people are anticipating, then you will see Indian bond is also rising. uh, but because the curve is what I said, steep, there are opportunities across different segments of the yield curve, and I'll explain to you why I say that. So the best way to play a rate hiking cycle is to be in something called liquid funds. So if you look at this chart, the blue line shows repo rate increasing, and the orange line is the 3 month government treasury bill rate. So as the repo rate goes up and as RBI sucks out liquidity and hikes interest rate, the interest rate or the yield on the treasury bill goes up. If I plot a portfolio yield of a liquid fund, which is a safe liquid, so it doesn't have credit, a safe liquid fund, it will actually mirror this rise. So as interest rates go up, the yield on the liquid fund portfolio and hence its returns also increases, right? With very little mark to market risk. Because in bonds, the longer the maturity, more the mark to market risk, the shorter the maturity, less the mark to market risk when interest rates increase. The liquid fund invests only in 91-day paper. So effectively every 60, 70 days, the portfolio is repricing. And if the rates are going up, then the portfolio is repricing and buying higher and higher yields. So this is I said, the best way to play a rate increase. A lot of people, we even we recommended that because savings account rates were about 3.5%, and liquid fund return also were around the same level. It actually made sense for you just to leave your money in savings account, but not anymore because savings rates won't increase. Right? Banks are not going to change that rate. But as RBI hikes, as we expect them to hike over the next 1 year, your returns from a liquid fund will increase. Generally, we recommend that liquid funds is not a return generating, return priority product. It is for safety and liquidity. But in this situation, there will be a difference between savings and liquid fund as and when RBI increases. So this is a kind of the best way to play the rate cycle. Because I talked about the yield curve, like if I look at where will the RBI, when and where, how much will the RBI hike? So today the operative rate is 3.5%. The RBI repo rate is at 4%, right? Even if they hike it to 5%, 10-year government bond yields are at 675, 30-year government bond yields are at 720. So that's what we call there's a difference between the repo rate, which is at 4%, could be going to 5%, and the bond is already high. So we also said that if your horizon is about 3 years, which is where the capital gain taxation also comes in, you might look at a combination of a liquid fund and say something like a short-term fund or a dynamic bond fund or a that some category which gives flexibility for the fund manager to manage. And as rates go up over the course of the year, keep allocating more toward like slightly higher to dynamic. So a combination of liquid fund which benefits from rate hikes and the fact that rates are already high. Some people can also do what we call target maturity fund. There are also these rolled on products that mutual fund has there. You do a 6-year fund. You can mix that and liquid fund, but that is the best way to play. But keep your return expectations lower. Liquid fund returns as RBI hikes should increase, but short-term, medium-term bond funds will have a challenge. And then if I get a question, I'll also answer how to think about investing in fixed income. We still believe gold is a better asset from a diversification perspective. And we talk about diversification, we're talking about risk diversification. You need a hedge against central bank stupidity. You need a hedge against political issues. You need a hedge against governments making wrong decisions, right? And that hedge typically, historically, and I think it will continue, is in gold. And this chart shows you that as central banks print money, the value of gold increases. But that's not the point. The point of gold is when things go wrong, does it protect my portfolio from a downfall? And we've seen historically, if you map out equity and gold returns, it does that. And the way we talk about gold is you should buy gold and hope that it falls, because if gold prices are going down, which means the economy is doing well, your jobs are doing well, your business is doing well. So you make your bulk of your returns through that allocation. And when things go wrong, whatever allocation you have in gold, 5, 10, 15, 20% in your portfolio, will do well during that period. We saw that at the start of the pandemic. Last 2 years, as economies recovered, you've seen gold underperform, and so be it. It's an kind of what we call a portfolio insurance in your mind to think about when you think about gold. Crypto, apart from Bitcoin, crypto also, the fact that whether we can call it a currency itself is a debatable, and I think that's what the major problem with crypto assets are from a central banking perspective. That it's called currency. They are financial assets. And in fact, they've become even more financialized than any other commodity that I've seen. Even gold is not as financialized as crypto has become. Right? Everybody now, even in India, you could see the ads that came about last year and trying to financialize crypto. So if you don't look at it as a currency and you look at an asset, then there are different ways to look about crypto. Right? Bitcoin has a very different purpose. It doesn't do anything. It's only a limited quantity supply of a financial asset, and the value depends on who buys and sells. Whereas most of the other cryptocurrencies that are there, crypto assets, have very different needs, have very different use cases, and their value is driven by the usage of that platform or of that currency or of that product. So there's a whole host of things. If somebody has a detailed question, then I can try and answer. But we believe from a risk diversification perspective, uh, it still should be gold. So you have fixed income, you have equity for wealth creation, fixed income for liquidity and stability, and gold as your risk diversifier. So I told you about how we look at things and how we've created a simpler way of looking at it. So we call this the 12 20 80. People would have heard me, would know about this. So we say use the 12 is the 12 months of your expense. So look at your monthly expense multiplied by 12 and see what amount that comes about. That's your emergency corpus. Uh, Especially after the pandemic, where a lot of people would have realized that having an emergency corpus is very, very important, right? Because you don't know when you're going to lose your job, or you get lesser business, or your businesses get locked down. If you're a restaurant owner or if you are a service provider, your business just got locked down for three to 4 months, and that emergency corpus is what helps you tide over these kind of challenges. So take 12 months. Depend now for a very young person just joining into the job, you might not need 12 months because you have your parents to provide for you. So that could be different. But otherwise, take 12 months of expense, put in a safe environment. That safe can be anything. It could be cash under your mattress. It could be money in your bank savings account. It could be money in fixed deposits. It could be money in a liquid fund. The objective should be that it should be safe and it should be liquid. Whenever you need it, it should be available without any mark-to-market loss on it. After doing that, whatever else you have, allocate 20% to gold and 80% to equity. This is what we believe is from a simplicity perspective. So if you do not want to time the market, if you do not want to figure out which asset class, just follow this. So your fixed income is your emergency corpus and keep it very safe and liquid. Do not take risk on that. And then do gold and equities in a 20-80 ratio. And this just shows you over a period of time why it might turn out to be better. This is historical returns from November 2004 to Jan 2022. So it's a very long period. And given equity plus debt plus gold, equity plus debt, equity, debt, and gold. So you can figure out where are returns coming from, what are the standard deviation. What maximum drawdown is, how much does the asset class has fallen in this period, in any particular time period. So and that matters, right? Because if you're very highly allocated to equities in say 2008 before the Lehman collapse, it had a very high drawdown. That's what the numbers are showing. That's why we say diversify, uh, diversify into different asset classes. And if you cannot do and cannot think about all these things, then just follow the 20-20-20-80 allocation. It might not be relevant for everyone, but for most people, I think they can just simplify their life by just following it. Another way to think about what you do. So the play is the play money, right? So cryptocurrencies, silver, stock betting, trading on tips is in the play segment. So when you're young, you don't have responsibility. You will tend to have a higher trading or a higher play portfolio. But as your family responsibility increase, you need to have sacred money, and then you need to have investment for wealth creation, and then you can have some allocation, very short, very small, 5 to 10% of a portfolio for different activities. Could be timing the markets, investing into sector funds, or investing into highly volatile asset classes like cryptocurrencies. So I'll stop there, and I'll be happy to take questions.
Hi, Arvind. Thank you so much for such wonderful insights. And I like the fact that you said keep it simple, which is ideally how it should be. Though I guess we all of us try to complicate our lives by trying our hands at different products, different and the fact that you said the 12, 20, 80 rule that we should be applying, but then you did speak about equity 80%, but then I think within equity itself there are so many options,
Yeah.
and I'm sure we'll have a lot of
Yes.
questions around that, where
Yeah.
within that 80% equity, where should we invest? So we will get to that. So let's start with the very first question that we got from our viewers, where someone's asked, like, from a retail investor point of view, if someone just wants to invest say 5 to 10,000 rupees per month, then how should they go about investing? And let's assume that this retail investor is relatively young.
So if you're relatively young, then you have risk taking ability, right? Because
Yeah.
you're not worried about losing a job because you're young and you will be able to acquire skills and acquire and get into a job or do a business. You have time in your hand to take this. So if you're in that scenario, then your a bulk of your allocation should be in equities,
Yeah.
right? For some people, it could be even 100%. And why not?
Yeah.
Like if you're in the 20s and you've done your education, you're not married, you don't have a responsible kids, and you can have a very 15, 20-year horizon for that allocation, and that should be in equities. And now you can choose from in different aspects of equities. Again, my suggestion is to keep it simple. So pick 3 or 4 equity mutual funds, right? Across diversify across categories. So you can have a mix of large cap, mid cap, small cap, or you can have a multi cap, right? Diversify across fund houses, uh, and and just make that allocation. So you can do it through a systematic investment. Whenever market falls, you should embrace market falls because your time horizon is 10-15 years. So whenever market falls, you'll be happy that you're a market giga. I'm able to buy long-term equities at a lower valuation. Great time. So you can invest lump sum. That's the way to think about it. The I won't talk about particular fund, but the other way to think, there are equity fund of funds, right? So if you don't know which fund to allocate, you can just do an equity fund of funds, right? Allocate to a equity fund of funds, and that equity fund kind of diversifies.
Yeah.
Or actually, a good thing also would be that if you're young, and as they always say, start investing early, and that matters, right? You take an advice, take financial advice, do a reasonably simple financial plan, and then follow it. But young, bulk allocation should be in equities, because if you have to generate that 10-12% returns, historically we know it's only come through equities. No other asset class has consistently given us that kind of double digit return compounding. uh, if you want to do direct equities, fine, I mean, that's your call. But if you're somebody who's not following the market and researching, then it's just better to be in equity mutual funds. Very simple, very cheap. It takes literally 5 minutes to open an account in any of your platforms or even in mutual fund websites. And it's just very simple. It just makes your life very simple.
And I think another important thing that the younger investors should keep in mind is that we all should have our financial goals, right? And when you're young, most of your financial goals are long term, right? I mean,
Yes.
children's education probably something you don't have kids, so you've not thought of it. Retirement is something that's long term. Buying a house is long term. So since most of your goals are long term, then obviously you should look at equity in a big way, like Arvind was saying, right?
Yes.
And then, of course, if equity is a big chunk of your portfolio for long term, then the market falls are something that you should be super happy about. Like I'm always very happy when markets fall because I'm like, yeah, I'm going to get more units now, right? So yeah, it's
Absolutely.
always a good thing. Yeah. What kind of funds should we consider for investments at this point if I'm a conservative investor? So at a time like this, though I know that, Arvind, we are all for long term and, we shouldn't worry about the
Yeah.
short term blips. But then,
Yeah.
I mean, if I'm a conservative investor and if I'm a little worried at this point, what should I invest in? Which kind of funds maybe should I invest in?
Oh, okay. I'll first do a very generic answer, which is, if you're conservative, generally, always, right? So it depends on why you're conservative. Are you conservative because of valuations, or are you conservative because you're just conservative from a risk perspective? So then it really depends on, if you're conservative from a risk perspective generally, then of course your equity allocation should be lower. Simple. And you have to live yourself, you have to agree to the fact that you will not participate in that 58% small cap returns, right? You will have a very low allocation to that because you're generally conservative, and that's fine. uh, so first you have to think about that. Also, I find people, lot of investors doing relative returns, right? कि ये fund में इतना पैसा मिला या ये category में इतना return आया, and मेरा portfolio में इतना ही return आया मेरा. I don't think that is important. What is more important is, what is your objective, and what returns are you okay with, and what volatility and what risk are you willing to take for that return, right? So if your return objective is 15%, but you don't want to take even 10% risk, there's no asset like that.
Yeah.
Crypto mein matka lag jayega, that's a different thing, but there's no sustained asset as of now, as we know about it, right? So it depends on what. So if your objective is that we are very happy with 8-9% returns, and you don't want too much volatility, which is a conservative in Indian perspective. 6% is FD returns, 9% is FD plus some returns, and 12% is equity returns. Right? That's how you look at it. Gold will also be somewhere in between that. So if you're conservative and not very risk averse, then you're in that 8-9% bracket. You should have a mix of equity and debt. A very like 80-20 will not work for you. 80 equity will not work for you because you'll be worried. Right? So it has to be 50-60, 50-50 or something like that. In that, there are options. So there is in mutual fund, there are multi-asset funds, right, which allocate between equity, debt, and gold, right? And that's generally positioned as FD plus, because if you look at in FDs, people have a lot of money, right? Banks have so much money in FDs, and that is giving you on average about 6.5-7% pre-tax. And the mutual fund industry is always saying that okay, and typically we've seen that you might do a 1-year FD, but you remain for 3 years, 4 years. So if you're going to remain for that longer, then why don't you come into a what we call and there's a whole host of things, right? Multi-asset say like a balanced advantage, balanced conservative. You remain in that. You will give you slightly FD plus returns with a slightly higher volatility, but after 3 years your taxability is better. Now, for those investors, if you're like that, you don't then need. So if you've chosen an asset allocation product, which is allocating to equity, debt, and gold, or you are doing this balanced advantage, which is the fund manager timing the entry exit, then you don't need any other fund. Then don't do so. Once you do a multi-asset allocation, then you don't go and do an equity product separately and then a fixed income product separately. All your allocation should be in a multi-asset product. Diversify across fund houses. Don't choose one multi-asset fund. That's the way to think about it. Because now my problem with the advisory by mutual funds on balance advantage is that they are telling you to invest in balance advantage, is a great fund because equity, debt, you manage the volatility. And then they'll also tell you to buy a small cap, then also tell you to buy a large cap. That doesn't make any sense to me. So if you're telling an investor to do balance advantage, then that investor should be, is that category investor who does not like the volatility of equities, but wants slightly higher returns than fixed deposits. Asset allocation products are very good for those kind of investors.
It's like, Arvind, when I also do a lot of my sessions, right, I'm always asked this question, and it's a very standard question I get asked कि मैम आप ऐसा प्रोडक्ट बताइए जिसमें रिस्क भी कम हो, रिटर्न भी अच्छा हो. तो मैंने कहा बेसिक लॉ ऑफ नेचर तो चेंज नहीं होता है ना, मतलब जहाँ अगर रिस्क लेना पड़ेगा अच्छा रिटर्न चाहिए तो. And that's always the case, guys. I mean, all of you have to remember that if you want better returns, you have to take slightly more risk.
People understand that CNBC is not there. Like the audience in CNBC is not you, right? You might have longer term horizons than the trader who is giving you allocations. Ki, this will go up, then this will go down. So as advisors like you will have to change the time frame in people's minds, saying that if your horizon is 10 years, then उनको क्या risk, मतलब आज का risk क्यों दिख रहा है? And you already have a plan. I'm helping you to do a plan. So you have to increase that risk framework in some sense for people.
So, next question is really what you anticipated anyways in your talk about cryptos. And, you said, yes, I'm sure cryptos ke upar question aane wale hain. So we have a question for you on cryptos from one of our viewers who's asking ki, of course, 2022 blockchain, a lot of people are investing in cryptos. It's like the next big thing. There's so much hype around it. So should I, as an investor, take exposure in crypto in this year? What should my crypto exposure be like?
I have no idea whether we should do it this year or next, or should have done it already. But this is my view on crypto. The technology is blockchain is very old. It's not new, and people are doing different aspects, and it's still not mainstream. Maybe it is getting usage is more. So as I explained, there are different kinds of crypto assets. There is, in one end, there is NFTs, which is non-financial tokens, mostly on art, and I don't understand that space at all in terms of how do I value that. Then there are, if I look at within cryptocurrency of what little I understand, so there is Bitcoin, where I know that the usage of Bitcoin is nothing. The Bitcoin is just a kind of an anti-dollar product, and it has a fixed issuance. So, right, gold also can mine. Bitcoin, after whatever 21 million units, it won't be able to mine. Of course, they will make it very small units, so divisibility will increase, but the actual thing, and that's a take against the fact that a central bank can print money whenever they want, whereas in a Bitcoin it cannot. So it will retain your value against the dollar, against the global currency, and that's okay. That gold also is supposed to do that. Right? That's gold fair value, and in terms of intrinsic value, is meant to do that there is a finite amount of gold in the world, and it has usage also, and hence people value gold, and that's the reason why central bankers own gold and not silver, right? Central bank and foreign exchange currency, they own gold in that. It's not diamond or silver, and there's a reason for that, and that's the reason, store of value. So Bitcoin meets one of, I doesn't technically meet, but it prays that value that it might maintain your purchasing power, to maintain your shoulder, because there is limited supply. But in terms of, if you're a currency which is medium of exchange, I don't see Bitcoin has not become a medium of exchange. And if an asset is so volatile, it will not become. I mean, it's very difficult for it to become a medium of exchange. Stable coins, as they're called, is a medium of exchange. So instead of dollar, there's a coin which is linked to dollar, and you have a wallet around it, and you can make trades and you can make transactions with that stable coin. It has value linked to the dollar. Those are fine. Those are innovations, financial innovations on an existing system. When the central bank digital currency will come, it will have, most of these stable coins also might lose, or it depends on who runs the platform. So if it's a big platform which runs stable coins and it's only accepts stable coins for transaction, then it's okay. Yeah. If I look at other cryptocurrencies, like say Ethereum or Binance or Solana, all the other ones, what I understand from them is they have some use case, which is there are Ethereum platforms which are doing what are called decentralized finance. So basically borrowing and lending through Ethereum. So as that platforms increase, the demand for Ethereum should go up, and that's the play. That's how it is. So it's not everything is a currency. I think nothing is currency. None of the crypto assets are currencies in that sense, because they don't make the two distinction. Because they are called currencies, central bankers are not going to allow it, because central bankers will want to have sovereignty on their issued currency, and that's why you're seeing all central bankers are issuing a digital asset, a digital currency. So then you figure out, then if it comes down to this, that it's not a currency, and not everything has use cases, or use cases in India right now or globally, then it really is as of now in the speculation mode. I mean, it might become very big, it might have a lot of use cases, but how much of your money you're willing to put on a very volatile asset class is something that you need to answer. Some of this could become very big, like say for example, Ethereum becomes the largest financial platform, right? And most financial transactions happen on an Ethereum platform, or Ethereum, and using Ethereum as a currency and Ethereum as the operating system, or whatever they call it in the blockchain. Then it can become very big and it can have a lot of value. So what I've advised to friends of mine who asked me, saying that tu finance mein hai, terko pata rahega, you explain to. I told this is the limited understanding that I have, and if you're doing it, diversify. You buy all 3 or 4 of them, because you don't know. I have no idea what is going to do well, what is not going to do well, and do very little. Like it should not be an amount which will keep you awake in the night. Yeah, that's my answer.
I mean, I just believe that, for your core portfolio, like, for the money that you're saving for your goals, maybe you should not have exposure to cryptos. The play money that you mentioned in your, presentation. Yeah, the play money, of course, you could play around with cryptos and see how it works. And once you understand, then of course you could probably invest a little higher, but your core portfolio should be invested in, the investment asset classes that we've discussed. So yeah. So how about foreign funds in the current scenario at this point in time? What is your take on foreign funds or international funds?
So if I look at trends when I'm saying foreign funds, I'm talking about equities for now, right?
Yeah.
So when you do international equities, you are diversifying away from a growth economy like India, right? And the major impact is the diversification. So people who are using foreign funds could be that you have a goal of getting a child educated abroad, and there's a payment of fees in dollars and pounds, and rupee depreciates against them 2-3%, and you need diversification. Either you can take it through gold, which is a decent diversifier, or you can also add equities to it. The other reason is some of the global growth companies are not in India, so you want to take advantage of that, right? And you just want to take advantage of removing a macro risk that you have in India. Like India had a tough time between 2016 post demonetization to 2020 COVID pandemic, and even in the pandemic, right? Growth was not high. In fact, growth fell to below 4%. equities didn't do as good. Some companies did very good, but the broader economy, the broader segments haven't done well. So if you want to diversify away from that macro risk, typically if you're diversifying away from an emerging market from a risk perspective, then you should be in the developed market, because that's where the size is longer, the economy is bigger, the markets are diversified, and you have very simple, cheap ETFs to play that market, right? So that's one way. So if you're diversifying for risk and rupee depreciation, macro risk of Indian current country and rupee depreciation, you should choose a developed world like the US, or a global international global fund which is diversified in the developed markets. You don't allocating diversifying from a asset allocation perspective into another emerging market might kind of defeat the purpose of risk diversification that you're doing. Short term, you can time China, you can time Indonesia. That's a different part. But if you're doing an asset allocation from a structural perspective in your overall asset allocation, it should be in the developed markets. And diversify into a global ETF, global developed world ETF, or S&P 500, something like that, which is diversified, and it gives you the flavor of the developed market. But it all moves in cycles. If you look at the developed market over the last 10 years, so 2011 to 2021, last 10 years, had a significant price increase. I mean, they have outperformed the emerging markets. They outperform India also. So if I look at S&P 500 against India from 2012 to 2022, it would have done better in dollar terms, right? For sure. So, but if I look at the previous 10 years, so if I look at 2001, 2002 to 2010, that the previous 10 year, emerging markets had a significant outperformance to developed markets. So again, so that's what we call about asset level. So you cannot be completely allocated to them, but if you can, India till the time the potential for Indian GDP is to grow at 6.5% consistent over the next 10-15 years, which would mean double-digit nominal growth, 10 to 12%, and corporate India will be better growing than the GDP. Listed companies will have much better efficiency. So that's the simple framework for Indian equities, and that should continue. So I don't see a point where you can deploy a larger allocation to international and lesser to India. So if you're an Indian, have a larger allocation to India, you can have that 5, 10, 15, 20% within that risk diversifier of, say, gold, rupee depreciation, or India macro risk. You can choose international funds. Global ETFs are very cheap. So, instead of doing stocks, just do a global ETF. It's
Yeah. I
at
mean,
the
even
S&P.
international fund of fund should be okay, right?
Even
What's
the
your
fund
take?
of fund should be. Yeah, even the fund of fund should be.
Okay. How about, what are your views on returns from lump sum versus an SIP investment?
It's see, lump sum is all about timing, right? So if you're March 23, 2020, if you could time it, lump sum. March 9, 2009, I remember, after Lehman, bottom of the market, lump sum. Your returns would have been much better than SIP, right? But how many can time? How many know that is the bottom? No one knows, right? And do you have money at that time to invest? And do you have the risk appetite at that time to invest? Like March 23, 2020 circuit, like the two, I think, like one large circuit, index was below 7,500 or whatever. You were scared because you had no idea what the pandemic was about. Right? So in those situations, so what I personally do during this time is, I don't know the bottom, but when I feel that markets have fallen, corrected enough equities, and I'm very happy with that, then I'll start doing lump sum at every point of time. What I also do is increase my SIPs during the term. So if I'm doing, say, 25,000 SIPs, I'll make it 50,000 for a 6-month period, because the market doesn't correct for more than that, right?
Yeah.
So you can take time like that also. Increase your SIPs and lump sum also in tranches. Don't do everything at one go. It's very difficult, right? If you would have on Feb 23rd, 2020, which was the start of the COVID fall, if you would have allocated 100%, you had a massive 30% correction after that, right?
Hmm.
So you have to straddle that. So
How
lumps,
about doing an STP at that time? How about doing
STP
an
also,
STP?
yeah, SIP, STP. So if you have money in a liquid fund or a debt fund, right, and your allocation is, equity markets have cracked by 20%, which means your allocation in equity has gone down. to STPs. The gateway to do it. But that's the way to time. You can increase your SIPs also, increase the STP amount, increase the switch amount. If you have money in liquid, switch.
Yeah.
Use that.
Okay.
Some
But
people will time. Some people may have to time because they have said they got a big bonus, right? So then they have again. I would say lump sum if you're very confident, or if your horizon is very long term, then it's okay. Then you can invest at any levels. But if it's not long term, if your horizon is short term, then you straddle your lump sum investments.
yeah, perfect. Yeah. So, there's upcoming LIC IPO, which is in talks. Everyone's talking about the LIC IPO. What impact do you think it's going to have on the equity markets in India, the LIC IPO specifically?
It is a big IPO, but the
Yeah.
government is going to sell 5% of it, and given by whatever valuations are going, it's about 50,000 crores. So that is not a big amount from a market perspective. I mean that's a small amount for institutional investors, retail investor digest. Indian market is fairly big, like $3 trillion of market cap, and a lot of people not invest in equity. So big company, but current equity sale in the market will be small. Even if they do 10%, 1 lakh crore, it's large. We've never seen anything like that. So it will take time to digest, but it is still not as large to have any negative impact on the market. I see all these things are good because look at the structure of the economy that has changed, right? In 20 years back, there was not a big IT services. Today, the large IT companies are so big and they are such a big share in the index. Look at banks, private banks. Nothing in till 1995, and then they many private banks they are listed and they're very very good, well run. NBFCs, not almost nothing before 2003 2004, barring HDFC, right? And now there are so many good NBFCs, very well run. And now you're getting the asset management companies, you're getting the insurance companies, general and life. Then you're getting all these fintechs, you're getting all this retail on. So these are all good aspects. The opportunity size and the investable universe is increasing every day.
Every day.
And
Yeah.
these companies, most of these companies, whether they're private equity funded or institutional funded, also tend to have better governance than earlier old age companies, right? Tends not everything will not be that. So the investable universe for good governance, good opportunity, reflective of the change in the economy, right? Fintech was nothing, like we didn't even know fintech 10 years back, but now fintechs are big. They're listed. Many more will get listed. So all these, it just increases the opportunity size, and as that happens, more money will come. Like today, you see valuations on some companies, some sectors very stretched because the opportunity and investable companies there are very limited. But as more companies get listed, more money will come. So money will find its way. Valuations will go up and down. But India is still only 3 trillion. It's 3 trillion, but it's only 3 trillion, right? There's so much more to go in terms of growth and in terms of investable companies in US.
Yeah. Yeah. Yeah, I mean, we did take that question, guys, for all of you viewers. But then, of course, that doesn't mean that we are promoting an LIC IPO or not
Yeah.
promoting it. We are just giving our views in terms of how it could impact the economy. Yeah. Okay. So, in volatile markets like these, should we move from stocks to mutual funds? What's your view on that?
Again, that is a mutual funds, I believe, are the best vehicle for 99% of the investors. There will be 1% who have the ability to research and time the markets and select stocks, and they can do it with their daily job or without their day job, whichever way. But there are some people who can do it. Apart from that, for rest of the majority, it is actually mutual funds are better, right? Also, what happens is when you do a mutual fund or you do 2 3 mutual fund schemes, you are diversified across styles, companies and portfolio. When you tend to do direct stocks, you're not you will be concentrated. How many stocks are you going to own by research? I mean, you can keep buying on tips, that's a different thing. But when you're researching and investing your money, how many stocks will you be able to do it? And you might have a concentrated portfolio which might do well if you pick well. If you don't pick well, you will have a problem. I'll give you my own example. So I said March 9 2009, right? That bottom of the market. I timed it. I put half my money in mutual funds and I bought stocks with half my money. The stock portfolio actually was zero after 3 4 years. When I sold, some stocks did very well, some stocks did really, really bad. Like some are like default company. I'm a fund manager. I'm not an equity fund manager, but and I can time the market, I can look at companies, I can understand balance sheets, but I still make mistakes. Diversified equity funds, all of them did well, whatever I picked. So that's the way to think about it. If you can do it, great. But if you 95%, 99% of the people won't be able to do it, won't have the time. So then why break your head? Just do mutual funds, cheap, easy to invest, simple to understand.
Yeah, and the expertise that comes with mutual funds, right? I mean, when you have a fund manager who's managing that portfolio for you, then why do you have to break your head over it?
Yeah, day in day out, they are doing for like indirect plans at 0.5% or 0.75% fees. You're getting the best of the research, best of the fund management.
Yeah, so true,
I would
so true.
agree.
Yeah. Okay, should I allocate more to small cap funds as I'm very young and then decrease it gradually? So for a young investor, are small cap funds a good way to go?
Over the long term, the thing is mixed. If I look at different time periods, there have been periods where large caps have outperformed small caps over a 10-year period also, depending on where you start, where you end, right? Opportunities is good. I mean, but we also seen that it is also volatile, right? So you're young, you have a longer time period, that's fine. Uh, the that volatility of how much can they go up and down. If you're okay with it, then maybe slightly higher allocation than last year. But you also have to understand that when macro environments get tough, like take 2018, right, when after the credit crisis, look at the fall in small caps. uh, it's not only liquidity. I mean, of course, as small caps also illiquid, so when people sell, you have a higher impact on both going up and going down. But certain businesses are not mature, right? Certain businesses do not have the management depth. Certain businesses do not have the product diversification or geographical diversification. That's the typical characteristic of small cap. So in a changing economy like India, in a stable economy, you might say, okay, large caps are done, and I'm not going to get extra returns, but small caps will give me more. In a changing economy like India, like just giving money, like Bajaj Finance, small cap in 2000, but large cap now, and it continues to grow, right? I mean, there are a lot of examples of wealth creation from large and mid cap companies also. So I would not say, maybe you can tilt your allocation slightly, but there is still a lot of merit in large and mid cap, large companies in India, because the structural economy is changing, and good managements, good balance sheets, good products have their own value. And
Yeah. And I guess in small caps, I mean, of course, timing of the market, I guess, is important in small caps. But at the same time, the universe of uh, a fund manager doesn't have a huge universe of companies
yeah,
to pick from, right? In small cap funds. So you're like in large caps and mid caps, a fund manager can take 40, 50 stocks in the portfolio. In small caps, that's not possible. So it obviously is, you're reducing your portfolio size by investing in, a
and
small cap.
governance needs to be a problem, right? People are
Yeah.
worried about that. I want to back good management. Handful
Yeah.
of good managements in India, to be honest.
Yeah. Yeah. So true. Okay, I think we can take this as a last question. So, should we expect another market crash during the month of March due to US, the Fed's recent statements and the possible rate hikes?
I don't know if anything specific or special about March. I know that the same March and May both tend to be volatile months. They they will be volatile. As I said, you expect market crash and market increase because of the dilemma that I talk about. Right? People's expectation and what Fed delivers. Can you hear me?
Your voice is cracking a bit.
Is it okay now?
Mm, yeah, I think it's better now. Yeah.
Okay. Yeah. So because the world is so used to low interest rates, high liquidity, a very easy Fed. So when the US Fed changes the law, there will be volatility. So I can't time when the market crash is going to come out or happen, and
And then your voice is cracking again. I'm so sorry, but
one minute.
not able to hear you.
Let me try and move to my hotspot.
Okay. Hi,
Sorry.
Arvind, are you there?
Yes, I'm the one that
But your voice is really not audible.
I'm trying to change my Wi-Fi.
Okay. I think is it a problem with your internet connection?
Looks like it.
Yeah. Oh, I guess we can end the session here because we are really not.
Is this
Yeah,
okay?
I think you're better now. Yes, yes, yes,
Yeah,
you're
okay.
better now.
I changed my Wi-Fi. Okay, so I was answering. Sorry about this. I was answering about the Fed. So
Yeah.
when the Fed increases interest rates and tightens liquidity and says that it no longer prioritizes growth, but it prioritizes inflation, it will have its impact. And you know what is normal? Like if just go before 2007, the US Fed funds used to be at 4.5%. US 10-year bond yields were at at about 4.5%. Uh, After that, growth collapsed. Things have changed. So maybe what was 5% normal then, maybe 3% is normal. But we haven't even been to 3% in the last 10 years. Only once or twice just touched and came back in. So if interest rates it actually goes to 3%, that is a very different environment, right? The amount of money that you're seeing now in say venture capital or private debt, right, globally, those all will come down. Because if I'm a global pension fund, global institutional investor, and I'm getting 3.5, 4% from US treasuries, then why do I need to take that all those risks to earn that 7, 8% from any other global asset class? So that will have its impact. Price of money will determine a lot of flows. So you should brace for volatility. And I think the US is a conservative society. When inflation goes up to such a level, the politics changes very dramatically, and so that's what has happened, right? So suddenly, from very very dovish and growth supportive, they've become like inflation. So so they will be hiking rates. How much and all, we'll have to see how the economy recovers. Will the economy take it? But asset classes will be volatile, which is why I said lower your return expectation this year. This year, my conditions are tough. India also, because of that oil prices, hike in oil prices, and interest rates going up in India. In India, interest rate does not matter as much because if you look at average interest rate, like average repo rate has been about 6.5%. Average inflation has been about 5.5%. Average 10-year bond yield has been 7.5%, and we are still grown at 6.5, 7%, right? Real GDP. So a 100 basis point increase in repo rate from here is not going to materially change our outlook on Indian equities, medium to long term, short term maybe. But the confidence channel, as we call it, in terms of global sentiment towards emerging markets, India's overvaluation against other markets, those all factors you put together, you should lower your expectations. Medium term outlook, as I showed in my charts, I think India is in a very very good situation. There are a lot of growth impulses. There's a lot of growth background. If we make sane policies and focus on job creation and infrastructure and demand support, I think India should actually have a very good next 3, 4 years.
Yeah, so like Arvind said that, I mean, since it's not the year to expect very high returns, I think this is a year to invest money in equities, not take out money from equities. Right? So yeah, but I guess, yeah, so we're done with the questions, and thank you so much everyone for joining us today. And I do hope takeaways in terms of how to really create your portfolio this year and get your questions. I mean, you can keep posting your questions and the Grow team will come back to you with the answers. So thank you so much, Arvind, and thank you to all the viewers for logging in today, and have a great weekend ahead, guys. Take care.
Thank you
Thank
so
you.
much, Namrata.
Thank you. Yeah. Bye, everyone.
Bye.